Hallelujah, the Fed is ditching quantitative tightening. TLDR, money printer will go burr at some point in the not so distant future, and more people are calling for that to happen sooner than later. But wait, at the same time, Ray Dalio was out here sounding the alarm, the legendary billionaire himself, hinting at a possible recession. WTF, right? When liquidity spikes, markets should moon. So why is this investing legend, this billionaire, trying to rain out our parade a little bit? Well, stick around. The ultra-rich didn't build empires of playing dumb, and be wise to tune in. So here's what's happening. The Fed just announced it's stopping QT, quantitative tightening. That is, running off their balance sheet, creating more pressure on the markets. And that they're planning to start adding reserves back into the system on December 1st. Not exactly doing quantitative easing. QT ending does not mean QE starts. What happens in that situation is a technical adjustment. But Ray Dalio says, do not be fooled. This is the first step toward QE, the same playbook used to juice the markets after 2008 and again in 2020. And when the Fed flips like this, it's a big sign. Liquidity floods the system. They'll take money from maturing treasury bonds, reinvest those bonds, aka not letting them just roll off, buying new bonds instead of taking cash out of circulation. In plain English, more money stays in the system, pushing asset prices higher. Historically, this is rocket fuel for risk assets, stocks, crypto, gold, whatever. At first glance, it sounds pretty damn bullish, and in the short term, it probably is. But Ray Dalio thinks this time could be different. He warns that the Fed isn't stimulating to save the economy. What's happening right now is that stimulating into a bubble that's already inflated. Can you keep pushing it up? Can you inflate it some more? Sure. Might look fine for a while even. But at some point, it pops. But yes, at the root of things, higher liquidity is usually bullish. But stocks are near all-time highs, credit is cheap and abundant, inflation is still above target, unemployment is pretty low, but it has been quietly rising in the background. AI stocks definitely heading into bubble territory, maybe not too deep into it yet. The Fed is pumping money into an already overheated market, and history says that tends not to end well, at least not long term. Now let's break down why QE always looks bullish at first and usually has positive impacts on the market, but it's usually the calm before the storm. You see, taxes alone can't cover all the money needed to run the US government. It should, but they borrow beyond their means and have been doing so for a long time. So the Treasury Department issues out government bonds, basically IOUs, to raise funds. Banks, pension funds, foreign governments, they all come together to buy them because they're considered to be one of the safest investments in the world. Don't bet against America, right? And they pay interest. When deficits get too big, the market cannot absorb all the debt without yields spiking. That's when the Federal Reserve steps in. Through quantitative easing, it buys Treasury bonds back from the market, usually from banks, paying with newly created dollars. In short, the money printer goes burr. They print money, they buy their own bonds. It's like a snake eating its own tail. At some point, it's a problem. When the Fed buys bonds, it injects liquidity into the system. Now, as bonds mature, the Treasury pays them back. The Fed can, of course, burn that money to shrink liquidity or roll it over by buying new bonds, keeping money flowing. Buying bonds raises their price, which lowers their yield. For example, imagine a $1,000 Treasury bond that pays a $50 a year interest payment. That's a 5% yield. If the Fed starts buying and that bond's price climbs to $1,100, the payout stays the same in real dollar terms, but the yield percentage drops to about 4.5%. Lower yields on safe assets push investors to chase higher returns elsewhere. Stocks, Bitcoin, meme coins, all that kind of stuff, right? It's like turning on a fire hose of money. The liquidity comes back. Of course it comes back. They're addicted. They have to have the liquidity. They have to have the money printing. They can't live without it, baby. Everything pumps. Sometimes things pump more than they deserve to. Now, before we get into the next part of this conversation, guys, if you're trading the cryptocurrency markets, you want to get yourself some Bitcoin to hedge against the insanity of the world, you want to make some money longing or shorting the market, BitUnix is the place to do that. It's available to anyone, anywhere. That's you. And it's never been a better time to sign up. They have insane bonuses going on right now. You have to check this out. Wild deposit bonuses. For example, put in $2,000, they give back $400, but they have crazy whale bonuses too. Put in $10,000, you get $1,000 back. $20,000, you get $2,000. $50,000, you get $5,000. Extreme limited time offer. If you want to sign up, you better do it today. Links down below. Go check it out. And look, what Jerome Powell's doing is not new. Every Fed chair since Alan Greenspan has done this. Markets wobble, they pump liquidity. QE creates a feedback loop, prices rise, confidence returns, borrowing increases, and it feels like prosperity, even though it's mostly just cheap money being flooded into the system. Dalio warns these cycles mask fragility. Everything looks strong until the music stops. Take the dot-com bubble. In the late 1990s, the Federal Reserve cut interest rates to stabilize markets after the 1998 financial crisis and the collapse of long-term capital management. So, cheap money came in at just the right time. It extended the tech rally for longer than it probably should have lasted. In fact, it went into a blow-off top as a result of this. It took about 2 years for it to happen, by the way. The Fed injected additional capital into the market at a time when investor risk appetite was already high. This was like pouring gasoline on a fire. Cool in the short term, problematic when it burns your house down. The Bank of England and other central banks kept policy very loose at the time too, amplifying global risk taking. The result, NASDAQ soared over 600% between 1995 and 2000, before crashing nearly 80% Afterwards, central banks cut rates again, pumped money back in again, helping markets recover, but also setting up the 2008 credit bubble. The 2008 crisis exposed a hidden problem. Banks were overly fragile. They made these long-term loans, like mortgages, but using short-term borrowed money. So when that borrowing dried up, guess what happened? Banks couldn't lend anymore. Businesses, consumers, no one could borrow money. And the economy took a real fast nosedive. To put this all into perspective, the Federal Reserve's balance sheet exploded from under $900 billion in 2008 to over $2 trillion by 2010. The first true era of quantitative easing, $1.1 trillion worth. Mortgage-backed securities were also collapsing. Interbank lending, it froze up. Consumer confidence absolutely plunged to its lowest levels seen since the 1980s. The Federal Reserve's response to all of this did stabilize markets, but it also began a decade-long addiction to cheap money, an addiction which still has not been addressed, and the markets are still addicted, the economy is still addicted. In fact, the addiction's worse than ever. Between 2009 and 2019, the S&P 500 rose by over 300%, while corporate debt as a share of GDP climbed to record highs. Companies used the liquidity not just to invest, but to buy back shares. Cool, that's a good idea. And inflate earnings per share. In short, QE didn't just heal the economy, it rewired the economy around the necessity of easy credit, lots of liquidity, and cheap money. Then came 2020, the biggest liquidity injection in modern history. In just 4 months' time, the Fed printed over $3 trillion, doubling its balance sheet to nearly $7 trillion. Stimulus checks, near zero interest rates, and corporate bailouts sent asset prices absolutely to the moon. The S&P 500 recovered its entire COVID crash in just 5 months, while at the same time, Bitcoin rocketed from $4,000 to over $60,000, eventually peaking around $69,000 in late 2021. NFTs were selling for millions of dollars, pictures of monkeys, very famously. Things got a little bit crazy. Meme stocks went from zero to millions. The result was the everything bubble. Real estate, equities, crypto, luxury goods, everything inflated by the same tidal wave of liquidity. The side effects were absolutely brutal. Inflation hit 9.1%, the highest in 40 years, leading to the fastest rate hiking cycle in the same time period. The Fed had to slam on the brakes. Fastest rate hiking cycle since the 1980s. It's absolutely crazy. In short, too much liquidity doesn't just boost markets, it can also make greed take over. Companies, the investors, everybody's out there, they're borrowing more, they're chasing bigger risks, and they're setting the stage for the next crash, which is fine, as long as you realize that this is the reality. Short term, mega bullish. Things are going to go crazy. Everyone's going to go crazy rich. People are going to start buying monkey pictures for $1 million again or some other stupid behavior like that. Then the big crash comes, potentially a generational crash. Here's the key. While Ray Dalio's warning sounds very scary, the silver lining here, okay, is that we can all get rich before the bubble bursts. Every bubble eventually bursts, but before it does, there's usually a massive euphoric top where Rolexes and Lamborghinis flood your timeline. That's where you want to focus. That's where opportunity lives. Despite the inevitable crash, QE is still bullish in the short term. Liquidity has one simple job in the markets. It fuels risk assets, or when liquidity is taken away, it pours water on the risk asset fire. When money is cheap, investors pile in, they buy more shit, prices go up. Stocks, AI plays, crypto, gold, real estate, whatever. Sometimes this happens in a very dramatic fashion. But eventually, reality will catch up. Now, we might have 6 months, we might have 2 or 3 years. Nobody knows. But we will have to pay the piper at some point for what the Fed is about to do. But now is not the time to get mega bearish, okay? We are in the regime change right now. How long all those easy financial conditions can keep the markets running is anybody's guess. But when the meltdown comes, it'll make you pay for all the sins of the melt up. History shows these final melt-ups can be very explosive, offering a chance to take profits at key levels if you're paying attention. The smart move, think like Ray Dalio. Prepare for both sides of the cycle. Ride the liquidity wave while it lasts, but plan for the eventual reversal, because a reversal always comes. Take profits, or the market will take them for you. Get ready to rebuy at discounts. Cash in gains, rebalance into safer assets like real estate, and be ready to buy again when valuations become more attractive for both stocks and for crypto. The dust always settles after any crash and provide great opportunities for those who have cash on hand, which will be you, because you're going to be smart this time. You're going to sell when things get crazy. You're going to sell the euphoria. This is the essence of the big debt cycle here. Boom, bust, repeat. Quantitative easing can lift markets higher than anyone expects, but it also sows the seeds of the next downturn. It always does. And it's not going to come very soon, but it is going to come. And this video should serve as a reminder to you. Don't get complacent when things get more exciting in the markets. Have a plan, stick to the plan, and get out with your profits, okay? Because it takes a real long, slow time to grind up. When markets turn, things go down real fast. Success isn't about calling the bottoms or the tops perfectly. Very few people do that. It doesn't really matter. It's about understanding the cycle, respecting risk, managing your risk, moving high-risk bets into low-risk bets to secure the bag when you get it, and acting deliberately. Keep your eyes open, and in times like these, everyone's shouting predictions. Most of it's noise. One truth cuts through it all. Nobody knows how long the run can go, how high it's going to go, how big the bubble's going to get, or any of that kind of stuff. One thing that is certain, when this current bubble pops, there will be a disgusting fall afterwards. You need to be ready for that. You need to grasp that when it comes. If you're planning for it, you're already ahead of the curve. You're ahead of most investors. Speaking of staying ahead of most investors, check out my free newsletter. It's awesome. No, seriously, it's great. You'll freaking love it. Link down below. We cover crypto, we cover stocks, cover macro trends, prediction markets, and much, much more. Link down below. It's free. Go check it out. Thanks for watching.